what happened recently in the markets is something you'd been kind of calling for. You're calling this a PE recession. What does that mean? That this was just a situation where valuations were set to come down?
Yeah, it was a piece actually you wrote about 12 months ago. And what we were looking at was the level of normalized earnings and the market's multiple that was applying to that versus where we thought things would settle down. You know, when we've chatted in the past, we sort of talked about the sort of enthusiasm that was in the market and people arguing that the PE of the market should be much higher on the ultra low interest rates, which if you assumed those rates were going to persist, was a valid argument. The case we were trying to make is that the rates had to normalize somewhat. So as you go through this sort of regime change, Becky, you know, moving from a reasonably hot economy into a colder economy, you generally see some movement on the PE, the valuation of the marketplace. And frankly, we hoped for that rather than a big fall in the price of the market itself, that it was more the earnings would come through and the market would be pretty much stagnant. But that usually also comes with volatility.
We've gone from 19 times PE to about 16 times. So does this market look cheap to you, or is this a valid valuation at this point?
I think that's valid. I don't think it's particularly cheap, but it does make me a little more optimistic for 19 and beyond because we have at least had that setback. You know, I would say 14, 15 is more what I would think is cheap, but 16 is, I think, a reasonable valuation because we are also seeing things slow down a little bit, and we should expect slower earnings growth going forward as well.
Anastasia, what about you?
Yeah, I think it's a reasonable valuation for the current market conditions, but of course, as you know, it's always a forward-looking proposition. So if the economy continues to deteriorate, I would suspect that we can see those multiples come down further. But I think right now what's really in focus is 2019 earnings and the fact that consensus is still calling for a pretty high number. Globally, we're looking for 8% earnings growth, and given the economic slowdown that we're seeing, given the tightening that we're seeing, given the yield curve developments in the United States, and of course, not to mention trade wars, I think that 8% EPS number for 2019 looks a little bit high. So that's what I'm watching really closely is what happens to earnings revisions, because at this point, I think that's what's going to drive market more than valuations.
We had a fund manager on early this morning who said that when you look at worldwide valuations for stocks, we haven't been lower in decades and decades.
Yeah, and I think it's especially true for certain pieces of it. I would say emerging markets are certainly looking very interesting from that perspective. You know, China, the degree of the derating and the multiple that's taken place makes that a very interesting, I would say, contrarian opportunity. So I would agree with that. And
are you encouraging people to invest in China right now?
It is one of our contrarian opportunities for 2019. And the reason I say that is because a lot has been baked in. And if you have anything go further right on the trade war front, I think that's one of the countries.
Are there any U.S. companies you think that have remarkable exposure to China that you'd actually recommend?
I think they are. They absolutely are. I mean, they're in the tech space, but I'm not sure that
most people are actually going the opposite direction on those.
Yeah, I'm not sure I would be recommending those at this stage because the challenge is the global cycle. And what's the most sensitive to the global cycle now, it's not the industrials necessarily, but it's the semiconductor component. And that's who ultimately would have some of the greatest exposure to China.
So, Colin, if you think that stocks are reasonably valued here, you are looking for some gains in the market next year. What are you calling, mid to high single digits?
More in the mid-level, because, again, as I said, I don't think it's particularly cheap. I just think it's fair value. I agree with Anastasia. I still think earnings expectations are a little too high. But if I combine that, I still end up in the sort of mid-single-digit area. And the issue is not that is that reasonably attractive versus other asset classes, but on the other hand, with the extra volatility, is that really a return that people are going to be excited about? But yeah, I think we'll end up with a small mid-digit return.
So the ECB left rates unchanged, but they did affirm that QE, I mean, I get a little bit misty about this. QE is any, so does that bring this chapter to a close until the next time, I guess?
This particular one, but it doesn't change a thing from the perspective of bond yields, for example. So one thing that's happened over the last number of years, ECB has amassed a whole lot of stock of sovereign bonds and corporate bonds. And in case of sovereigns, it's about 21% of the amounts outstanding. So just like the stock of purchases way down the treasury yields in the United States, that could be the case for European bonds as well. So that doesn't change. I think what does change is that there is an incremental change, and we'll be looking for rate hikes at some point from the ECB. But given the data flow, that's not an imminent proposition by any means.